Well, federal officials reportedly talking with Taiwan about boosting trade between the two economies as the federal government looks for alternative markets after all those recent trade swipes and strikes coming from China.
But our next guest says the China issue, compounded by the end of year profit taking, shouldn't deter focus from a strong 2021 for Aussie markets. Paul Ashworth joins us now from Cameron Harrison, live via Skype from Melbourne. Paul, welcome back to the program. There is a lot of noise, understandably, about what's going on with our relations with China at the moment. Of course, the story as well is made even more bewildering by what's going on with iron ore prices. But longer term, you think despite what's going on with China, things are looking pretty good for us next year?
First of all, good morning, guys. Great to be back. That's right. We think through the course of certainly the first 3 quarters of 2021, the balance of risks are very favourable still to equity risk. That's not to say, and you rightly point out, it's not to say that there aren't some headwinds there, because there certainly are. But those key conditions where we find ourselves in terms of households and their, if you like, their excess and surplus savings, and secondly, simply housing prices, housing affordability, housing construction. And it's really those 2 key things, together with the fact that we have monetary policy clearly indicating that there is nothing on the horizon in terms of rate tightening. Those 3 things are very supportive to equity risk, and particularly on a relative basis as it relates to Australia on a world growth basis.
Okay, so that's the case for strength for equity investments in 2021, particular to Australia. What's the bad? I mean, we've got a lot of expectations now on Australian corporates to perform well.
Sure.
We're expecting to see some earnings upgrades coming through between now and reporting season. But when do corporates risk disappointing through 2021, and how?
I think that combined with valuations, we can talk about good relative merits of equity risk, but they don't come cheaply. And to that point that you raise, yes, there's a point where, if you like, the big mattress that's been provided by monetary policy, been provided by fiscal policy, and how markets have viewed that from a macro sense. We would suspect, probably, by the second quarter, certainly, 30 June next year, the market will focus on, individual enterprise growth and what those sequential growth rates look like, and correct. The risk is then that they actually start pricing, for some of the valuation perfection and hopes for perfection, that are in those prices at the moment.
So is there a general rule of thumb, Cameron, for how you can avoid those pitfalls in 2021? Because it's a broad conversation. So are there certain sectors that you are looking at with more caution when it comes to that narrative playing out?
Well, yes, certainly, where growth has been priced expensively, and on the revenue side of valuation, certain cautions provided there. Our focus is very much on the firm and the enterprise valuation metrics, and we're there to pay for profit. We're there to pay for profit growth. I think one of the challenges in the Australian market is to actually find that that good quality industrial property growth. So that's probably one of the key challenges that we find. And as I've said before, in recent discussions with you guys, we see better outcomes in terms of those quality industrials in the US and in the UK. But
Mm-hmm.
Paul, given what's going on with China and Australia at the moment, has it changed your investment thesis whatsoever when it comes to moving forward? Because of course, we know that iron ore is doing very strongly at the moment, but we know that China is targeting other items as well. How do you play the environment, the investment environment, where you're not sure exactly what's going to happen tomorrow?
Yeah, look, a key position that we have is that from 2022 onwards, once we get past or I don't know that we necessarily get past the politics of China's trade actions, but we certainly have to deal with China's own growth problems and the ability for it to grow its economy over the next 3 to 5 years. In the short term, we do see positive outcomes, but it's more driven by a lack of circumstance. Stimulus itself out of China in terms of fixed investment, and if you like, the significant own goal, from Vale in Brazil, sees a solid underpinning for iron ore through 2021. So for us, it's not to overplay that position, because we are mindful that through 2022 and more significantly beyond. We are somewhat pessimistic in terms of commodity prices, particularly those bulk commodity prices.
One thematic that we are obviously keeping an eye on, I mean, it's not a thematic, it's something we check every day about 1 million times, is the Australian dollar. At elevated levels. We were just chatting with our previous guest. Consensus is increasingly that we'll see 80 US cents next year.
Yep.
As an investor, how is that starting to play into your thesis and where you're looking to invest or not?
Well, it certainly plays to that short-term position. Certainly as a relativity to the US dollar, somewhat to the euro and to the pound. It's one of those headwinds. It's probably a lesser headwind, through the course of 2021. We're not going to be experiencing significant inbound tourism. We're not going to be probably experiencing significant inbound education. So it does have somewhat more of a muted impact. But yes, it certainly comes at a point in time where it's pretty inconvenient for the Reserve Bank, where they're getting to the point of having exhausted their conventional policies for stimulation. They want domestic demand, they want strong domestic demand, they want a bit of inflation, and it's one of the headwinds that they would not be appreciating at this point in time.
Yeah, Aussie dollar sitting at 75.55 in early Asian trade on Monday. Paul Ashworth, Cameron Harrison, Chief Investment Officer, thanks for joining us on the program this morning.